Good afternoon. Today we will be talking about how to use the comparable approach in valuing real estate to determine fair market value. This is one of the most important things we can do in real estate, especially in real estate investing, and that is determining fair market value of a property, because we don't want to overpay. And when we're selling or disposing of property, we don't want to leave money on the table. So if this real estate investing thing sounds pretty good and you want to learn more, head on over to callseth.com and we can talk about your goals and where you want to go with real estate investing to change up your life. So the comparable approach to real estate investing. As you know, if you follow my other videos, there are two ways to value real estate. There's the comparable approach and the income approach. We will be covering the income approach tomorrow. So today we will concentrate on the comparable approach. So what is, I was drawing, there we go. Let me get this. It looks like I was drawing waves on the ocean. I was really just testing the lighting because I've noticed that we have a glare over here from the light. So I'm just trying to figure out the right thing. So ignore the little squiggles I had before. So comparable approach. I'm not even going to try to fit the whole thing on the board. So comparable approach. As the name, you'll actually, if you watch HGTV a lot or some other real estate shows, you'll probably recognize the word comp. And comp goes into comparable. They are interchangeable, but most people just like saying comp because it sounds more, I guess it sounds trendier, you could say. Sounds like you're in the know. But the comparable approach is taking an apples-to-apples look at different properties that share similarities, whether it's location, size, number of bedrooms, upgrades, renovation, that sort of thing, to use what has sold recently to determine a fair market value. This is used predominantly for residential properties and plexes. So you could have a triplex, duplex, fourplex, a quad, fiveplex, sixplex. Those types of properties will almost always be valued by an appraisal, by an appraiser or the lender using the comparable approach. So I'm going to give you a couple of examples of what the comparable approach, what it looks like in action. So we'll draw 1, 2, 3, any street. Right, this is where you're going to get, I could draw a pirate ship. I'm not sure about a street. So we'll draw a tree. Maybe we'll have another tree. Actually, this is turning out okay. So we'll have property A. We'll have property B. And we'll do property C just to make things good. Okay. So comparable approach in action. So let's say property A is a 3-bedroom, 2-bath. This one here is a 2-bedroom, 1-bath, and this one here, let's say it's a 3-bedroom and 2-bath. So this might sound really, really simple, but trust me, it does get more complicated as we go along. And if you stick around until the end, I will tell you what real estate investors have to fear from the comparable approach. So if we're trying to determine the value of, let's say, property D over here, this is the one up for sale. Let me draw a for sale sign. There we go. This one's up for sale, and we are trying to figure out its value. And this one is a 3-bed, 2-bath. And so we need to find some comparable properties. Property A, 3-bedroom, 2-bath. That sounds like a pretty good apples-to-apples comparison. Property B, a 2-bedroom, 1-bath. It seems a little dissimilar. An extra bedroom and an extra bathroom certainly does add a lot. You're going to be limiting your buyers to probably a couple or a couple with one child with a 2-bedroom property. And with property C, 3-bed, 2-bath. So these two properties here would be the best comparables to determine the value for this one. So we would be looking at upgrades, lot size, all those sort of things, and comparing it to these two properties right here. Now, let's say, I just got rid of my excellent for sale sign. I'll have to add that back in. There we go. Property is still for sale. Okay, so let's say this property now has a bigger lot. This property is original inside, so let's say it's original to 1970, complete with orange shag rug, and let's say this property has a finished basement. But everything else about the houses is the same. So these are, let's say these are all 3-bed, 2 baths now. How do we really weigh it? And this is the conundrum, you could say. So actually we can recap. So I've used albeit, what other words have I thrown out? But conundrum is the word of today. So today's word, today's episode is sponsored by the letter C for conundrum. So this is a conundrum faced by property appraisers. They're looking at these similar comparable properties, comps, and now they have to weigh the pros and cons about each of them and give weight to a certain upgrade or give weight to a larger lot size. And this is where appraising becomes an art form, because it's not property valuation using the comparable approach. It's not set down in numbers. There's an art to it, and you have to have a feel of the market. So with the bigger lot, original inside and finished basement, and let's say this one's a typical, it was renovated early 2000s, and it's a pretty basic lot. Well, we know the bigger lot house, if it looks decent inside, a bigger lot will command more value. So this one would be probably superior, we could say. A finished basement. Finished basements, depending on where you are, if it's a finished accessory apartment, so basement apartment, in a residential unit, basically converting it into a duplex, that can certainly make that attractive to an investor coming in or a new buyer looking to have somebody help pay their mortgage for them. So this one could be a little bit better than this one without a finished basement, and originals would be inferior. So when we are doing the comparable approach, we have superior and inferior properties. And when you do look at appraisals, depending on who's doing them, what state or province you're in, you may see columns for superior, inferior, and all the deductions and additions in value based on what those upgrades or features are. So in this case here, we're comparing our subject property to the bigger lot. So if this one sold for, let's say, $500, and this one sold for $470, and this one sold for $400, we would know that certainly we're above $400 for our subject property because this one's all original. Bigger lot, unfinished basement, sold for $500, so we know we're capped out, so we're somewhere between $400 and $500. Finished basement, $470. So depending on your market and all that sort of stuff, again, we're just using basic numbers, and just for the example, maybe you could peg yourself around $450 for the value of the home. So let's change things up and look at this from a real estate investor standpoint. And let's say all of these now are rental properties, and we have tenants inside. And we can say this property here is renting, we'll talk about annual gross rent. So let's say this one's renting for $20,000 a year, gross. Let's say this one's $15,000 gross, and let's say this one is $17,000. So here is the trick question. If we are using the comparable approach, what difference does the gross rent make? If you want to put this in the comment section, feel free to do so. What difference does the gross rents make or have on the value of the property if we are using the comparable approach? Trick question. The answer? A big fat zero. Because in using the comparable approach, we are just looking at the features and the benefits of each property. We do not care about the income. And this can be one of the downsides for real estate investors. And let me explain why. The lender, using the comparable approach, is looking at similar properties around the area, depending on the type of property. It could be the same street or neighborhood, or if it's more unique, you could be expanding your circumference around the property in terms of your search area. But the lender and the appraiser are just going to be looking at similar properties, because if 3 properties that were the same size, same number of bedrooms sold for this price, then chances are the subject property, the one that you're looking at, will be selling around that same price. If it's selling for more for no good reason, then you've probably overpaid according to the lender and the appraiser using the comparable approach. But let's say you're a real estate investor and these are other investment properties, and you've worked, and some people have worked really hard. So this property, they've pushed rents, they've managed it well, they've kept it up. If all of these properties are similar size, similar bedrooms, similar features inside, and the only difference is the rents, you're not going to get an extra value from the appraiser for that, because the appraiser is just looking at the comparables in terms of the physical property. So there's a good side and a downside to this as a real estate investor purchasing these residential properties or these small plexes. If you're buying, if you can find a property, and depending on the state or province you're in, you may have rent control, which makes this even more important because you can't really push rents as much. Let's say I'm a buyer right now and I'm looking at these 3 properties, and they are very similar except for the rent they're bringing in. We have $20,000 gross, 17 or 15. If these properties are going to be appraised roughly around the same value, because the appraiser and the lender will be using the comparable approach, I'm going to be taking this $20,000 gross rent for sure, especially if there is rent control, because it's going to be too hard to buy the exact same property, almost the exact same property, but the gross rent will be less. That puts you in a worse position if you are a buyer, unless you have a really solid game plan. But if you are dealing with rent control, like many states and provinces are, that can be pretty difficult to do. But on the flip side, let's say you are a seller and you are selling your single family rental and you've done a good job pushing up rents, but the comparables in the area, there's lots of comparables, there's lots of 3-bedroom, 2-bath houses. The appraiser will not be looking at your rent. So even though you've done an excellent job pushing rents, you could be commanding the highest rents in the area. Unfortunately, according to the lender, if you're doing a refinance or if you're selling the property and an appraiser is coming in for the buyer, you're not going to be getting extra credit for the work you did to push the rents up. So there's the good side and the downside to using the comparable approach to value properties. So if we do want to get credit for the income we're bringing in on the property, we have to use what's called the income approach, and we'll be covering that tomorrow in the video. So if you have any questions about the comparable approach and how that could affect your portfolio, or if you say, hey, listen, I don't even want to deal with all of these valuation methods, I just want to invest in real estate, set up a call with me on callseth.com, and we can chat about what real estate can do for you. So if you want to get credit for the income you're bringing in, it's called the income approach. And this approach assigns a value to every dollar of net income coming in on the property. So it's not going to be an apples to apples comparison based on the size and the features. Obviously, with larger commercial properties, you do look at price per unit, price per square foot, all of that. But when it comes to valuing these larger commercial properties, you are assigning a value to each dollar of net income and what sort of return or what somebody's willing to pay in order to capture that net operating income every year. So we're going to be covering this tomorrow if you are interested in valuing or looking at these larger commercial deals, whether it's retail, industrial, multifamily. We'll be using a multifamily example because that's what I'm looking after right now. But comparable approach, it's good if you're buying a single family home, smaller plex property, you will be encountering that with lenders and appraisers. But if you want to go big and you want to actually have the work you've done on the rents and your gross rents and your NOI, reducing your expenses, if your balance sheet is looking pretty good, chances are you want to be using the income approach. So hope this was helpful. Put your comments and questions in the comment box below. And if you want to hop on a call with me and chat some real estate, just go to callseth.com. Have a great day.